Hi guys, my name is Adnan Hasbi and I'd like to welcome you to another episode of Rambling of an Endless. In today's episode, we're going to talk a little bit about inflation and also returns from our investments. I think one of the reasons why I'm talking about this is a lot of people, I heard right now, have been talking about how inflation is a silent thief with regards to the money we keep. And if we keep money in the bank, and if we get about 4% returns, chances are after a period of 20 or 30 years, if we continue keeping that money in the bank versus today's inflation, we would lose money. So the goal of today's episode is basically trying to break down why inflation, if it's high, and why if our returns is low, is going to impact our portfolio negatively or is going to impact our wealth negatively. We're going to look at it through the lens of a Malaysian, and I'm trying to break this down so that this information will be easily understood for every one of us. So let's go on. So in a nutshell, let us start with this basic simple thing where as human beings, we need to look at our basic needs. So our basic needs as a human beings are as follow. Number one, we need shelter. Second, we need food. Third, we need water. And fourth, we need clothing. So these are the main items that we need to consume in order for us to survive. This is an economic theory. So right now, knowing that this is our basic necessity, let us look at the food inflation. In the United States, there is this very popular food inflation indicator called the Big Mac indicator. But for Malaysia, since Roti Canai is a very popular dish, I have created a new index called the Roti Canai Index to measure the inflation. So right now, going through the internet literature, I noticed that Roti Canai in the 1970s were about 30 cents. Then 1980s, it became 50 cents. 1990, 70 cents, so on and so forth. And today, as of 2021, first quarter, the prices of Roti Canai is at 1 ringgit 60 cents. So we can see the major jump between 30 cents to 160. So over here, what I've done is I took the prices for Roti Canai during the 1970s and I use it as a base. And right now, as of the first quarter 2021, Roti Canai is about 160. And if we were to just do a simple calculation, we get 430% of changes between the 50-year time period. And if I were to divide that by 50, we will get about 9% of inflation just on food alone. So what does this really mean? Assuming if we have invested in funds which gives us returns of about 5% or maybe 7%, and right now inflation is about 9%, what will happen in 30 years, assuming if we are going to retire in 30 years, what will happen is that even though we have returns for our investments, it's not enough to beat the inflation. So the cost of living will outpace our investments. And after all, one of the reasons why we want to invest is eventually hit financial freedom. So moving forth, always have this question in our heads. Is the returns high enough to beat inflation rates? Okay guys, I just wanted to share with you guys this. And I hope that with this quirky indicator, it made finance a little bit more understandable, a little bit more fun, and a little bit more bearable for everyone. Okay, so I want to end this episode by saying if we look at the Malaysian All House Price Index, we can see that in 1988, that was the base, and 2017, it rose almost to 600%. So effectively, the house prices actually rose by 20% per annum. Yeah, that's actually quite a scary thought. So I just wanted to just bring this out for everyone's awareness, and do always keep this in mind that should we want to invest, always know our hurdle rates. And I think one of the better hurdle rates we can use is inflation. Alright guys, with that, take care and I hope to see you guys in the next episode.